Welcome to the latest Motley Fool scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Jason Hall and Tyler Crowe giving a 1 to 10 rating to a company that's increasingly gotten interesting to investors in an AI world. It's Digital Realty Trust, ticker symbol DLR. We'll see if it's interesting to Jason and Tyler. We'll rate the strength of its business, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Jason's at a 5. Tyler, you're at a 4.
Yeah, look, I think Jason might be a little bit in the minority here for these, so take our opinions for what it's worth. You just picked us. The theory, I think, of data centers makes a lot of sense, like demand for cloud and edge compute and storage for all of the purposes, generative AI, autonomous vehicles, virtual, anything that's basically a digitization trend makes data centers, they're going to be in high demand, right? However, unlike most real estate businesses, because this is a real estate investment trust, typically that business has low capital costs for maintenance and things like that. You can pretty much run a bit like a warehouse, doesn't need a lot of extra money put in all the time. Data centers do. Actually, data center REITs have the highest recurring capital costs for HVAC systems, for upping the power going into a system, cooling, all of these things. So it eats into cash flow. Now, if this was a regular corporation, structured without a dividend in the REIT structure, I might score it actually considerably higher. But I think the REIT structure and needing to pass along 90% of profits of net income as dividends actually puts it at a disadvantage, especially at a time when capital is so precious.
Yeah, the best REITs are the ones that own irreplaceable assets, or they have really deep relationships with their tenants that make them indispensable, or they have big cost of capital advantages. And Digital Realty really doesn't have any of these in any way that works as a return generating advantage for investors. And a lot of it's, again, tied to that REIT structure is a big part of it.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you have 5s, Tyler.
Yeah. And again, this isn't about anybody in particular at the company, but I think it's an indictment of the corporate structure and governance. I think management is trying to serve two masters. Its incentive structure says grow same store net operating income, which is basically how much money per data center they get. And to, and then at the same time, the restructure says pay dividends, which is a high per share total company sort of thing. The board, I think, should convert to a C Corp. If they did, I would give them like an 8 or a 9 on this scoring because it could show they were willing to make the hard decisions.
Yeah, I came as a 5-2, and I want to be clear, that's a fine management team, nothing exceptional here. As a matter of fact, they're kind of playing the game on hard mode because of that structure. And if you look at the results of the stock, they look incredible, but they're not aligned with the results of the business. It's the AI tailwinds that are driving the stock. The business has begun to do better with the AI infrastructure build out. But guys, this is the same REIT that almost gutted its dividend about 3 years ago because of debt leverage, because they got way over their skis investing in capacity, paid a lot of high premiums to buy and acquire a lot of assets. At the time that the market was really saturated for data centers, AI demand saved their bacon. It wasn't savvy management.
For financials, a 10 is a fortress, a 1 is yikes. Guessing these are going to be low given what you've said on structure, and both of you have 4s, Tyler.
Yeah, for too much leverage for a business that needs to plow that much capital back into the business at any given moment. 7.1 times debt to EBITDA ratio is high for almost any rate with low capital requirements. One that needs to invest like data center REITs is, in my opinion, nerve-wracking. I think to make matters worse, it's issued 15% of its market cap in new shares over the past 5 years. It's like really no wonder they haven't raised their dividend in 3 years, and going back to the possibility of actually cutting it not too long ago.
Right. You think about issuing shares, your interest expense there is having to pay that dividend when you're a REIT, right? So that's the cost of capital. Taking on debt there's the cost of capital. This is such a cyclical industry, capacity demand constraints, boom and bust. And again, having to continually reinvest. It's such a tough position. There's a reason why it's had to form joint ventures with others to co-fund some of its expansion. It doesn't have the balance sheet strength to be able to do it on its own. And debt's growing as a result of that, on top of the growth of the share count.
Valuation time, Jason. How well will Digital Realty Trust stock do over the next 5 years, and how safe is it? 10's a sure thing. 1's a lottery ticket.
So optimistically, I think 5 to 10% probably on the lower end. And you think about, hey, the yield right now is close to 3%. That seems really, really low. But management has to avoid cutting the dividend, right? And it's no guarantee. I think we're 3 years into having held firm with it. It's no guarantee that there's not still going to have to do it, because we have to assume that AI cloud infrastructure demand cycle continues to hold up. There's absolutely no promise that that's going to happen. And it's going to run into the reality of having taken on all of that debt, continuing to have to spend money to upgrade. Safety scores of 5. I don't think investors lose money. There's a chance they do, but this is not a safe REIT based on both the business and what is a really rich valuation with investors chasing, the AI opportunity.
Yeah, I went 0 to 5% with a safety score of 5. Something's got to give here. I don't know what investors are looking at in Digital Realty Trust and saying dividend growth is like coming back very soon. If I'm the angel on management's shoulder, I'd be telling them to convert to a C Corp now instead of waiting until its debt situation has actually become untenable.
If you do, you get an 8 or 9 score from Tyler Management. Thank you to both Tyler and to Jason. They've given Digital Realty Trust a low overall score of 4.5 out of 10. Not much sunlight anywhere in their evaluation. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Waste Management. Till then, Fool on.